Thanks for tuning in to Talking Point on BloombergQuint. I'm Niraj Shah. If you want a dash of cautious optimism when you're looking at the markets, there is one place or one house whose reports you should try and read. They identified some of the trends way earlier than the street, particularly in BFSI as well. Of late, I've been reading the reports on the commodity space, metals, cement, what have you, and there is a touch of optimism there as well. And therefore, my questions to our guest today, Mr. Mahesh Nandurkar of Jefferies, is about how optimistic is he feeling at the current point of time when the markets are already trading at record highs, and what is his outlook for 2021? We are probably about 20 days early or 25 days early, but this is the chance that we have to speak to him. So let's get him in on the show and try and talk about all of that and more. Mahesh, so good having you. Thanks much for joining in. Hope all is safe.
Thank you, Neeraj. All's well, and good to see you.
Likewise, Mahesh. That's a simple question, right? Very basic, very elementary, maybe difficult to answer. But how do you feel about the markets currently now that we are no longer at 8-9 thousand, but at record highs?
Yeah, so the markets have obviously moved up, quite significantly, and we have been optimistic, and we continue to stay that way, Neeraj, because yes, one can argue that the markets have moved too fast, too soon. But if you look at the trends globally, and if you look at specifically what has happened to the risk-free rate itself, I would argue that while on a headline basis, the market appears to be expensive, Nifty trading at about 21 times 1 year forward earnings. But given where the risk-free rates are, and if you compare the P multiples with the risk-free rates historically, then we are not really out of the whack, as such. That's point number one. Point number two is we are clearly just about, started the phase, according to me, of the cyclical recovery. And we have been talking about real estate driven, real estate led cyclical recovery. We are seeing some very, very initial signs of it, and that we believe if that theory proves to be right, we would be looking at close to 35% plus earnings growth for Nifty in FY22, and then maybe another 15-20% easily the subsequent year as well. So I think a combination of low risk-free rates plus the plus the expected cyclical recovery makes us optimistic, on the market outlook, despite the fact that we have had such a big run. Yes, there could be some pullbacks here and there, but we would use those pullbacks to add on actually.
Um, who would have thought it would take a COVID year to bring about the earnings surprise, isn't it, Mahesh? Um, just before we get to that, just a word on how you see the world as well. There is, I mean, LA, for example, day before yesterday or yesterday issued lockdown notices too. We're seeing some of those getting extended in Europe. And while the question marks around stimulus remains as to when it will happen, we have seen the interest rates in the US not alarming, but crawl back to that 1% mark too. Are all of these worrying signs or setting the deck for maybe a potential pullback of sorts?
Yes, we definitely have to keep a watch on how things are unfolding in the West, in Europe, and also in India. And for that matter, we did see some spike in COVID cases here in Delhi as well, and that led to some state governments imposing some kind of restrictions. But those have been pretty mild, in my view. And my understanding, is that and this is also based on chat with some of the senior bureaucrats in Delhi and in the other parts, that lockdown is not really being seen as a sort of a all-in solution for the problem that we're facing right now, because obviously it comes with huge economic cost as well. And thankfully the COVID trajectory in India has, eased off from the September peak, and we are also about 15-20 days, from the Diwali festive season as well, and haven't really seen any meaningful uptake over there as yet. So. My feeling is that probably we will not really see very large kind of lockdowns, here in India, and the extent of lockdown probably elsewhere in the world is also not going to be as intense as what we had seen earlier. And the second point is that now the central bankers are already kind of seen this type of crisis once. And while that's not our base case, but if there were to be a very large second wave globally, the central bankers know exactly what to do, the governments know exactly what to do. And my sense is that any risk off on account of that is going to be short lived, even if that happens.
So a bit of a known and not an unknown entity anymore. Just a question on the money flows as well, Mahesh, because it's such a strong month in the month of November. My question only is this: that do you reckon that while I agree with you completely that India is probably not going to see a lockdown of sorts again, but if the situation in the West worsens, but at the same time India doesn't, do you reckon the money bags in the West would be as kind as they have been in the month of November? What are your key clients telling you about their desire to put in more money into India?
I think what we've seen is while India saw very large inflows last month, that is actually a part of a global trend, right? Where several emerging markets have seen large inflows, and increasingly the belief is that the dollar is going to be stable to a slightly weaker currency, and that kind of an environment is considered good for flows into emerging markets. So India is going to be, I mean, we will receive our own fair share, within those flows. So it's more driven by what's happening globally. But also at the same time, the investor sentiment is also buoyed around the fact that the economic recovery that we've seen here in India is without really any big government support as such. I mean, we have been tracking, all the numbers. If you look at the last 3 months, the central government expenditure is actually down 25% plus on a YOY basis. So unlike what we have seen in the West, where a lot of recovery is driven by huge government spending, that's not the case here in India. So therefore, the numbers that we are seeing here in India are private driven and therefore more sustainable in my view. So yes, I mean, as I said, I mean, if you see a second wave elsewhere or maybe some other reasons, maybe possibly some some reduction in the liquidity globally, maybe if RBI talks about some change of tone in the liquidity environment, that can cause some kind of a some kind of a pullback. But as I said, those pullbacks will probably be time to add in my view.
Actually, that was going to be my next question. Anything significant expected out of the RBI? I reckon a pause is in order for sure, looking at the stubbornly high inflation. But do you expect the commodity to be dovish?
Yes, the thing is, the CPI inflation has been, significantly higher than what RBI has been forecasting. I mean, our own sense is that by the end of this financial year, the inflation would have trended down to about 5.5% by March 21, which is still slightly higher than where RBI's forecasts are. But the thing is, it's still okay because it is still going to be within that 2 to 6% band that RBI has been comfortable with. So my sense is that so long as we are going to see inflation trending below 6% over the next few months, which is what our base case is, and which is what I think RBI is also expecting, it should be okay. But yeah, I mean, we have been seeing, over the last few weeks, both types of liquidity being infused. One is the dollar purchase driven rupee liquidity. Additionally, there have been these OMOs as well, and that has what has really kept the lid on the yields. So even a small change in RBI toning can drive the yields up a little bit, but my sense is that is still going to be a small move even if that happens. So once again, I would say that something that I'm not too much worried about at this point in time.
Okay, so just before we get to the India conversation, Mahesh, am I understanding this correct that the rising cases in the West or some potential small changes in the language by the Reserve Bank or otherwise, none of these factors worry you too much? At best, you reckon that there could be a small pullback, which you said that you will actually utilize to tell your clients to add more into India.
That is right. Yeah.
Okay. Now let's shift focus to India and um, I, um, the earnings that happened and the post earnings commentaries that you heard, or forget post earnings, even the other commentaries that you would have heard when you speak to corporates currently, are you getting a confidence that India Inc. is a lot more bullish on their own business prospects than before? Or is it a bit of a 50-50 situation currently?
Well, see, the thing is, when we looked at this, recently concluded result season, we ended up raising earnings estimates for nearly 80% of the companies that we cover. So, very, very broad-based earnings
Wow.
surprise, be it like cement, autos, banks, NBFCs, and you just name it. And I honestly believe that the confidence is largely driven
Okay, I think we've just lost Mr. Nandurkar. We'll just try and get that back, and I'll probably request him to start from the answer again. But the key point that stood out for me when he just said that they raised the estimates for 80% of their earnings universe, and maybe is what uh, that is what gets him to believe that the earnings growth in the year ahead, FY22, I heard Mahesh Nandurkar say that the earnings growth could be as high has 35% in FY22, followed by a fairly healthy earnings growth in FY23 as well. So I think that's the key thing that probably drives the optimism that Mahesh Nandurkar has. And keep in mind, I think while we just wait for getting him back, keep in mind they probably have been one house that has steadfastly been of the opinion that it will be a real estate driven recovery of sorts. I mean, one of the centerpieces of this move up would be the real estate driven demand and the real estate driven multiplier effect, so to say. And they've actually been bullish on the real estate names as well within the listed space. So I think that's the conversation that I want to have with him. One, on the earnings. Two, what pockets drive the earnings? And three, where is it that they are the outliers? Where is it that they believe things will improve compared to some of the other houses and what they believe in? So this morning, for example, viewers, when I was reading the note that Jefferies has put out, for example, they've given their opinion on Ultratech expansion plans and what they mean. They've also spoken about the metals surge, and I think their note seems to suggest that both Tata Steel and Hindalco, amongst names, are the ones that they are very bullish on because they believe that the steel cycle and the metal cycle has started and is probably here to stay. So I think we got to try and understand from Mahesh Nandurkar, where is it that the pockets of strength now stay on. Okay, I think we're just getting him back. Mahesh, good to have you back. May I request you please
apologies.
start from the beginning? You were mentioning the point about how the earnings upgrades from your end. What about for 80% of your universe?
Yes, so I was just mentioning that, and apologies for this technical glitch. So yeah, we have seen very, very broad-based earnings surprises across various sectors, and as I mentioned, 80% of the companies that we cover ended up seeing earnings upgrades. And frankly speaking, I don't recollect, what was the last time when we had seen something like this. So my sense is that yes, I mean the corporate commentary has definitely been quite good, which has what has driven these upgrades not just for FY21 but for FY22 as well. And my sense is that while some part of the earnings surprises have come through because of cost savings, but my sense is, and as we go forward, the cost savings will unwind to some extent, but then at the same time the YOY numbers on revenue growth would also be better, and therefore that should be an offsetting impact. So yeah, so therefore, as I said, I mean, we are looking at a very strong next year, almost 40% earnings growth, 35 to 40% earnings growth. And if our thesis on property-led cyclical recovery turns out to be true, we will see multiple years of strong earnings growth.
Inshallah, as they say. Mahesh, by the property-led recovery, you mean that what real estate would be the central pillar around which the multiplier effect would take place?
Yes, I think so. I mean, just to give you some numbers, like housing market as a share of GDP, was at about 10% of GDP back in 2012, 13, which was the previous peak. Now we are looking at, number close to about, 5.5% or so of GDP. So in the last 8 years, about 450 basis points, or on a, if you just do a simple math, about 60 basis points of negative drag on the GDP every year has been created by slowdown in the property markets. So if the markets, stop declining, we get those 60 basis points back, which we were losing. And if the the real estate market begins to improve, we'll probably get plus 60, plus 70 basis point kind of an impact. So on an overall basis, uh, we sort of in a very well see that over the next 3 to 5 years, the housing market alone can add 1 to 1.2 percentage points to the GDP growth. And we are seeing some initial signs of the same as we speak by way of incremental transactions. And the fundamental basis for the same we've been arguing for a while, which is a big improvement in the affordability with the rates going down, etc.
Yeah, I just mentioned when we were waiting for you that you guys have been one house which has steadfastly maintained this whole optimism around real estate as a pocket and maybe the multiplier effect too. So Mahesh, let me ask you a slightly difficult question. I was reading your notes this morning that have come out since last night about metals, about cement, etc. Um, would you would your overarching bullish view be on principal real estate, the listed universe there? Because now it is a reasonably large universe compared to what it was, say, maybe 3, 4 years ago. Or is it on ancillaries? And by that, I mean cement, steel, labor led, some of the other sectors where because the demand improves there. Where would you be bullish fundamentally from a stock perspective as a result of this thesis?
So we are super bullish on the property developers. That is one of the biggest, overweight sector that we have had, and that segment is clearly going to be, the most direct and the primary beneficiary of the trend that we are, talking about. And for that segment to do well, I believe the market share gains alone is a good enough reason to justify the bullishness there. I mean, one doesn't even have to subscribe to this view that the housing market will bottom out and will grow substantially over the next 3 to 5 years. Even if you don't agree with that view, the sheer fact that the market share shift is happening from weaker players to stronger players, that alone is a big positive for many of the listed developers, and will be the beneficiary of this trend. But our argument is more broader than that, and we are talking about, as I said, the broad-based economic growth coming through, helped by the housing market. And then obviously there will be a lot of ancillary plays, including including the mortgage players, including the companies that lend to the developers. We obviously have then the cement companies and the other building material plays like the tiles, ceramics, etc., the plumbing pipes. So yeah, there is a whole host of segments and sectors that one can play.
Okay, interesting. Yeah, I actually narrowed it down to just one or two. Excuse me for that. I'm glad you spelled it out. Mahesh, the other bit is what happens to the non-domestic focus spaces which are supplying to the world, so to say. I mean, IT has been at the forefront, yes, but because of the PLI schemes and otherwise, we're now seeing one electronic manufacturing, yes, but pharma and specialty chemicals also come to the fore. The stocks have had a good run up, but the commentaries from the companies are bullish. Are you guys constructive there?
Yeah, so I think the PLI scheme is obviously very, very interesting, and it definitely is a big positive for the sectors, for the specific verticals and the specific companies that are benefiting out of it. We are quite optimistic on the electronics manufacturing as a theme, although there are not that many listed plays to start with. Yeah, but that theme appears to be quite attractive to us. And yes, and there will be some select stocks and select kind of industry verticals or sub verticals which will get positively impacted. But if you just ask me at a slightly broader level, on the exporters, Our view is that first of all, as I mentioned, we are looking at more or less a steady dollar or maybe slightly weaker dollar, and so to that extent, the usual tailwind that the exporters get by way of currency, the rupee depreciation, is not going to be that big a tailwind, going forward. And secondly, which is a more technical factor, is that over the last several years, because the cyclical sectors in India were doing so badly, the money was, had shifted away from cyclical sectors into, these, somewhat safer sectors like staples and maybe to some extent even like IT and pharma and some of the other names. And we definitely see that as the cyclical recovery pans out in India, that money will be shifting. That process has already started in my view, but as things go forward, you will probably see a greater portion of funds getting allocated to the domestic cyclical recovery part. And so, while nothing wrong, as such, in the exports outlook, etc., but it just, I believe that the investor sentiment will, take some part of money away from staples for sure, and also to some extent from the exporting sectors, which have had the benefit because of lack of domestic growth in the past few years.
Okay, last question, Mahesh, and that is on. So traditionally, the argument about value and growth is that value means the Ben Graham style: go out and buy just the valuation, ignore the quality. I'm not talking about that. Let's leave the bad quality companies out, but within the good quality space, uh, do you reckon that if your thesis is that money could move out of staples and exporters into the domestic scene, some of these are still very well priced? Would you reckon that value will take precedence over growth in terms of valuations, at least? Because uh, people might just want to play both the earnings growth and the P multiple expansion as opposed to just the earnings growth. What is your sense? What is it that you would advocate?
See, the thing is, these types of change in investment styles are, is a pretty big statement, and it is, and some of these style changes actually happen globally. So, sitting here in India, we have to basically watch these trends globally as well, and then correlate that with what's happening in India. And mind you that this shift from growth to value has been talked about several times in the recent past as well, in the last few years as well, and hasn't really proved to be a very successful strategy, at least over the last 3 to 5 years. So I won't be making a very broad-based statement like move away from growth and buy value. I'm not of that view, although the cyclical growth recovering, etc., might make you kind of feel that the money is going to move that way. But my sense is I'm still going to be focusing more on where the bottom up fundamentals are, where the sector fundamentals are, and wherever we are seeing the traction in terms of growth recovering, is where we will be advising investors to put money. So yeah, so I would refrain from making a very broad based statement like that, but yes, I do state our preference for the cyclical recovery plays like property and financials at this point in time.
Got it. Mahesh, it's December. Before we thank you, something out of the blue though, either a really good book that you have read or are reading, or a really good report that came out from your stable, which we should try and storify on BloombergQuint.
Oh well, there are lots of reports that we have come
One
out
that
with,
was favorite.
Yeah, so while there are like several reports, and we kind of keep on coming out, with interesting thematic notes as well. So we've written a few notes on the housing market recovery in India. So that is definitely something that I would highlight from among the reports that we have done.
Okay, I'll read them up and maybe try and put them out on BloombergQuint once again for our viewers. But Mahesh, take a moment to thank you for joining in today. I really appreciate your time, and have a great month of December.
Thank you very much, Neeraj, and thanks a lot to your viewers, and best wishes for the next calendar year.
Yep, thank you so much. Look forward to have your opinion back again. But thanks so much for today,
Thank you. Cheers. Bye bye.
and thank you. Bye bye, Mahesh, and viewers. Thanks for tuning in to this edition of the Talking Point.